Today, we're going to cover what I consider the underdog of dynamic withdrawal strategies, Bengen's Floor-Ceiling. Despite its potential, it hasn't received as much attention as Guyton-Klinger Guardrails and Vanguard's dynamic spending rule. I'll compare all three to help us get a feel for how each behaves under different conditions, and share insights from Wade Pfau's analysis. I'm also planning a follow-up video comparing these strategies using real market and inflation data, so if this interests you, consider subscribing for future updates. Bengen's Floor-Ceiling is one of the first, if not the first, rule-based dynamic withdrawal strategies, introduced by Bengen in 2001. Despite its age, it remains relatively overlooked in retirement research. Wade Pfau is the only expert who has consistently covered it. It has largely been overshadowed by Guyton-Klinger and Vanguard strategies, introduced some 5 and 15 years after Bengen's. I'd be interested to hear why you think that is. Let me know in the comments. So, how does it work? The Bengen Floor-Ceiling strategy sets hard dollar limits on withdrawals, with the initial amount calculated as a fixed percentage of the portfolio balance, typically higher than a constant inflation-adjusted strategy. Each year, the percentage is recalculated, but spending is adjusted to the ceiling or floor, limiting fluctuations. The floor and ceiling are based on fixed percentages above and below the real value of the first year's withdrawal. Bengen's 2001 paper used 25% for the ceiling and 10% for the floor, noting that these values were arbitrary and more of a starting point for exploring the strategy. If you're familiar with Vanguard's dynamic spending rule, you'll notice similarities. Both use a percentage of the portfolio to calculate the initial withdrawal and then apply hard limits. The key difference is in the calculation of these limits. Bengen's limits are based on the real value of the first year's withdrawal, while Vanguard's uses the previous year's withdrawal to calculate the limits. This difference means that in bear markets, Bengen's strategy reverts to an inflation-adjusted floor, keeping pace with living costs, while Vanguard's strategy could experience a prolonged decline in spending. We'll discuss the pros and cons of Bengen Floor-Ceiling later, after we evaluate how it performs in the two scenarios from my Guyton-Klinger video, and compare the three withdrawal strategies. Stick around for the examples and a summary at the end. Now, let's compare Bengen Floor-Ceiling with Bengen's 4% rule and Guyton-Klinger Guardrails. While you might think Bengen's Floor-Ceiling aligns closely with his 4% rule, it doesn't. In fact, Bengen's 4% rule is the basis for Guyton-Klinger, not his own floor-ceiling strategy. Both the 4% rule and Guyton-Klinger adjust withdrawals for inflation each year. The initial withdrawal for the first year is a set percentage of the portfolio, such as 4% or 5%. Guyton-Klinger differs from the 4% rule in that it includes upper and lower guardrails. For example, if you start with a 5% withdrawal rate, the upper guardrail might be 6%, and the lower guardrail could be 4%. Since inflation is already factored into the target withdrawal, there's no further inflation adjustment for these thresholds. This contrasts with Vanguard's and Bengen's methods, which use percentages of the portfolio to calculate next year's target withdrawal, but apply actual withdrawal amounts to determine the thresholds. Additionally, Guyton-Klinger applies a 10% adjustment to these thresholds to determine final withdrawal amounts, while Vanguard and Bengen simply apply hard limits. Let's now dive into the two scenarios from my Guyton-Klinger video, one with a later bear market and the other with an earlier bear market, to see how Bengen Floor-Ceiling works. Afterward, we'll compare it to Guyton-Klinger and Vanguard. We'll use the same assumptions, a starting balance of £1 million and a 5% initial withdrawal rate. Here's how our spreadsheet is set up. If you've watched my Guyton-Klinger video, you'll recognize the format. The target withdrawal is always a percentage of the portfolio balance, and I've assumed a 3% inflation rate. This brings us to the key part, the floor-ceiling calculations. The real costs are adjusted annually for inflation, while the ceiling is set at 25% above this amount, and the floor at 10% below it. I've also included the relative percentages for the floor and ceiling, based on the current portfolio value. If the fixed withdrawal rate of 5% falls within these limits, we use that target amount. The floor and ceiling are hard limits that are applied, if the target withdrawal exceeds or falls below them. For the first 2 years, we'll use the target amount based on the final withdrawal rate of 5%. The next 5 columns calculate the new portfolio balance after withdrawals, considering market performance. The following set of columns helps us understand how far final withdrawals deviate from real costs, both annually and cumulatively. As you can see, we're withdrawing 1.46% more than real costs due to strong returns of around 10%. In year 2, we withdraw £52,250 from £1,045,000, which sits comfortably within both the floor and ceiling limits, while exceeding real inflation-adjusted costs of £51,500 due to good market performance. Let's extend this example over the full 7-year period. Target withdrawals are based on a percentage of the portfolio balance. After strong returns through year 3, the market drops by 30% after year 4. This highlights the challenge of relying solely on percentage-based withdrawals, volatility. While it sets a starting point, we must apply the hard limits we established earlier. Before reviewing these limits, let's compare target withdrawals with real, inflation-adjusted costs. In the first 4 years, the portfolio suggests we can spend above real costs. However, after the bear market in year 4, spending falls below real costs for the rest of the period. This is because we haven't yet factored in the floor and ceiling limits, which ultimately dictate what Bengen's strategy allows. As we saw, the target withdrawals breached the ceiling in year 4, then dropped below the floor starting in year 5. When applying the final withdrawals, we see Bengen's strategy recommends the ceiling limit of £68,300 in year 4, and floor limit of £50,600 in year 5. Years 6 and 7 remain constrained by the floor, as the portfolio struggles to recover with minimal gains around 5%. A couple of key points emerge. First, the strategy is very responsive to short-term market movements, due to its reliance on percentage-based calculations for target withdrawals. Second, while withdrawals decrease after the downturn, the floor ensures income won't fall below the set minimum, which adjusts for inflation but lags behind actual spending, fixed at 10%. This limits spending volatility and helps maintain purchasing power, but this may impact portfolio longevity. Before moving on to the next scenario, let's quickly assess the shortfall relative to real spending. With ceilings set at 25% above and floors at 10% below, the shortfall is positive in the early years, indicating we're spending more than the constant dollar scenario. By year 5, the floor becomes more significant as the portfolio struggles to recover. The shortfall shows that final withdrawals lag behind market performance by a full year, with the year 5 shortfall hitting the floor limit after the bear market. This perspective is helpful for understanding how the Bengen Floor-Ceiling strategy operates, showing how withdrawals align with the limits and shape the overall strategy. Now, let's move to the second scenario, where the bear market strikes early, in year 2. Target withdrawals are based on the portfolio performance. A sharp decline occurs in year 3 after a 30% drop at the end of year 2. Following this, there's a strong recovery, so let's overlay the real costs to assess the impact of 2 years of income reductions if we relied solely on percentage-based withdrawals. When we factor in the floor and ceiling limits, we see that the ceilings were never breached, but the floors were breached twice in years 3 and 4. During these years, the target withdrawals were £34,700 and £48,500, both falling below the inflation-adjusted floor limits of £47,700 and £49,200. Applying the hard floor limits, we see that Bengen's floor-ceiling strategy responds quickly to short-term market shifts, increasing withdrawals post-bear market. Spending recovers rapidly, even exceeding original real spending levels, mainly due to the strong bull run post-crash, which saw the portfolio value increase by nearly 97.5% between years 3 and 6. Although this scenario is somewhat synthetic, it has its basis in historical market recoveries. The key takeaway is the strategy's responsiveness to market rebounds. When looking at the shortfall, the results are the same but from a different angle. The withdrawals in years 3 and 4 hit the floor limit, which helped the portfolio recover. This was followed by a bullish phase that allowed for an almost immediate increase in spending. While the examples we've looked at are based on synthetic data over a relatively short period, are there any emerging patterns? Let's consider 2 key points: how much the strategies deviate from real costs, and the final withdrawal amounts. Starting with scenario 1, the annual shortfall and final withdrawal amounts offer 2 perspectives on the withdrawals recommended by each strategy. All 3 strategies respond to the year 4 bear market by reducing spending from year 5. The real question is how each strategy handles spending in the subsequent years. Bengen shows the greatest annual volatility due to its 25% ceiling and 10% floor. We see a 35% reduction in spending in years 5 and 6. However, the Bengen decision rules prevent income from dropping below the 10% floor from year 5. On a positive note, Bengen allowed higher spending in years 3 and 4, prior to the market crash. Guyton-Klinger is more conservative on both sides of the market crash. It doesn't allow as much spending compared to Bengen or Vanguard and is quicker to reduce withdrawals, though not as fast as Bengen. Vanguard exhibits the least volatility, as its floor-ceiling adjustments are based on the previous year's withdrawals. However, in an extended downturn, you could see significant declines in withdrawals. Vanguard also stands out for consistently maintaining withdrawals above real costs throughout the 7 years. Now, looking at the cumulative results over the 7 years, Vanguard leads in total spending, helping you maximize enjoyment of your retirement savings. Guyton-Klinger is the most conservative with Bengen 20% higher in total spend. Bengen at least allowed us to spend more in years 3 and 4, exceeding even Vanguard before the crash. It also responded the fastest to the year 4 market downturn. For those concerned about withdrawal volatility, the key is discretionary spending. If you have discretionary spending, say, between 15% to 30% of your total spend, you can adjust your withdrawals to suit market conditions. From this perspective, a 10% cut in withdrawals relative to real costs doesn't seem as challenging. And remember, the floor will never drop below 10% of real costs. Moving on to Scenario 2, Guyton-Klinger is even more conservative than in Scenario 1, due to the earlier bear market. The first time it increases withdrawals significantly is in year 7, 5 years after the market crash. That's a long time to stay underwater. Vanguard remains the least volatile, but again, caution is needed for extended market downturns. Bengen reacted quickly to the bear market and was also very responsive to the strong recovery, allowing higher withdrawals than Vanguard from year 5 onwards. The cumulative shortfall shows how much Guyton-Klinger reduced withdrawals. Despite the 97.5% bull market, it ended 54% below cumulative real costs. However, it did increase spending later on, but not enough to recover from the lost years. Both Bengen and Vanguard were more responsive to market conditions, making up for the lean years after a nearly 100% market rise. Let's briefly turn to Wade Pfau's analysis and conclusions. Between 2015 and 2023, he evaluated various dynamic withdrawal strategies, with his December 2016 articles on the Retirement Researcher site being the only ones to include Vanguard in the comparison. One key paper, How Much Wealth Will You Have 30 Years into Retirement?, evaluates strategies using a 20% ceiling and a 15% floor. We will focus on 3 key metrics: real spending after 30 years, remaining wealth after 30 years, and spending relative to baseline. I'll skip the downside spending volatility, as it's largely comparable. Pfau used data from 1926 to 2015, for a 30-year retirement with a 50-50 portfolio, starting with $100,000. Among the 3 strategies he analyzed, Bengen had the highest real spending and year 30 spending relative to baseline, though it also had the lowest remaining wealth. If your goal is to maximize spending, Bengen has an edge. However, if you aim to balance high spending with leaving a legacy, Vanguard leads in remaining wealth after 30 years, albeit with some sacrifice in spending. In a later paper, Pfau analyzed the same strategies with a different objective, ensuring only a 10% chance that real wealth would fall below $15,000. He evaluated various initial withdrawal rates to achieve this. The key takeaway: Bengen's initial withdrawal rate was the lowest of the 3 but still at a respectable 4.84%, yet it still resulted in the highest final real spending, only 2% lower than baseline after 30 years. In contrast, Vanguard and Guyton-Klinger saw significant drops in final spending, with Vanguard at 64% and Guyton-Klinger at 31% below baseline. Despite these steep declines in real spending for Vanguard and Guyton-Klinger, Bengen actually had higher remaining wealth than Guyton-Klinger after the same period. Now that we've looked at how these strategies perform under varying market conditions, let's summarize the pros and cons of Bengen's floor-ceiling strategy. Let's look at the pros. First, simplicity. Bengen's floor-ceiling strategy is easy to understand and implement, with clear, inflation-adjusted floor and ceiling limits based on real costs. Second, sequence risk mitigation. By reducing spending during market downturns, this strategy helps protect the portfolio from being depleted early due to poor market performance. If a downturn causes the fixed percentage withdrawal to fall below the floor, the strategy switches to a constant amount withdrawal at the floor level, preserving the portfolio during tough periods. Third, preservation of core spending power. Since spending is inflation adjusted and protected by global hard minima, retirees are less likely to face drastic cuts in their spending. Unlike Guyton-Klinger, which can cut spending sometimes a little too aggressively, Bengen paces the cuts based on the floor. Fourth, responsiveness to market performance. The strategy adjusts withdrawals based on market performance, allowing for increases in good years and decreases in bad ones. This responsiveness makes Bengen more flexible than strategies like Guyton-Klinger, which reacts more slowly to upturns. However, this flexibility comes with greater year-to-year volatility and withdrawals. Finally, balance between enjoyment and sustainability. Bengen's strategy aims to balance spending enjoyment with sustainability, adjusting withdrawals to avoid overspending in bull markets and excessive frugality during bear markets. While Bengen's floor-ceiling strategy offers numerous advantages, there are also some important drawbacks to consider. Let's take a closer look at the potential cons. First, limited research and support. A major downside is the limited research and adoption of the floor-ceiling strategy. Most studies, including those by Wade Pfau, primarily focus on 30-year retirement horizons with little attention given to longer retirements. Additionally, tooling support for this strategy is scarce. Timeline Planner is one of the few retirement planning tools that incorporates it. Second, portfolio depletion risk. While Bengen's floor-ceiling strategy provides a safety net, it also introduces the risk of portfolio depletion if market performance remains poor for an extended period. I ran the numbers for 1966 using a 4% initial withdrawal rate, and Bengen's strategy to sustain a 30-year retirement. As Pfau observed, though, it results in the lowest remaining wealth of the three strategies by a wide margin. In fact, Bengen's approach could stretch to 38 years before depleting the portfolio. By comparison, both Vanguard and Guyton-Klinger strategies still had significant reserves, if leaving a substantial legacy is your goal. Third, potential for higher year-to-year volatility. The floor and ceiling limits can lead to higher volatility in annual withdrawals compared to Vanguard's maximum 2.5% reduction. Retirees may experience larger fluctuations in income, but discretionary spending can be adjusted within the allocated amount to mitigate this. Fourth, potential for suboptimal spending. Depending on the set floor and ceiling percentages, suboptimal spending may occur in certain market conditions. This issue isn't unique to Bengen. It applies to all rules-based withdrawal strategies, including Vanguard and Guyton-Klinger. Finally, lower initial withdrawal rate. Bengen's initial withdrawal rate tends to be lower than Vanguard and Guyton-Klinger. This is an important consideration due to the retirement spending smile, since retirees typically spend more in their early go-go years. That said, the initial withdrawal rate of 4.84% that Pfau tested is quite respectable for a 50-50 portfolio. While dynamic spending strategies can mitigate some risks, particularly during volatile markets, they can't fully eliminate all retirement income risks, such as sequence risk. This is where complementary strategies come into play. If you'd like me to delve deeper into these in a separate video, let me know in the comments. For now, here's a brief overview of 7 strategies that can enhance your retirement plan. First, think about how you can manage discretionary spending. We've touched on this while discussing Bengen's hard floor limits. Understanding your discretionary spending in advance is critical. It acts as a buffer you can trim without affecting essential expenses. These spending flexibilities can provide valuable breathing room during market downturns. Second, consider building up cash reserves. Holding 2 to 3 years' worth of living expenses in cash reserves serves as a vital buffer. It allows you to avoid selling investments at a loss in down markets. Another option is adopting a bucket strategy. This can further ease pressure to sell growth investments during a market downturn. I suggest exploring the simplified bucket strategy I discuss in another video. It is an example of a bucket overlay on the total return approach. This method is designed to provide peace of mind without the added complexity of traditional 3-bucket strategies. Fourth, explore additional income streams. Supplementing your retirement savings with additional income can make a substantial difference. Options might include phased retirement, part-time work, or rental income. Fifth, downsizing might be worth a look. Unlocking home equity can offer significant financial relief, especially for those still managing mortgage payments. However, it's worth thoroughly exploring other alternatives before committing to downsizing. Sixth, supplement your income with annuities. Though annuities have become less appealing in lower interest rate environments, fixed-term annuities can still be worth considering. They can cover a portion of your essential expenses, reducing reliance on retirement savings. That said, this peace of mind comes at a cost, so weigh your options carefully. Finally, don't overlook withdrawal heuristics. Guyton's inflation rule, introduced in 2004 and later integrated into the Guyton-Klinger Guardrails, is one example of a withdrawal heuristic. Beyond skipping inflation adjustments during tough times, you might also consider applying an inflation haircut, reducing withdrawal amounts slightly to better align with market realities. If you've made it this far, thank you for joining me today. Let me know in the comments if you have any questions. And if you found this video helpful, don't forget to like, share, and subscribe for more content. Thanks again for watching, and I'll see you in the next one.